Thanks everybody for being here. Thanks Jay for the invitation as well. Looking forward to this presentation. I usually have a lot of macro charts to share and a lot of macro ideas in general, because that's one of the things we do. We manage a global macro fund, long short, and also a precious metals focus strategy. So important disclosures page. If you want, there's a link in the description of this in our website as well, if you would like to look over that. Expectations. Every year I start the year looking at what are my expectations for the year. And when I look at the market today, clearly we have inflation decelerating as one of the most crowded views. The second one would be the Fed will pivot. And the third one is the stocks will perform well on the back of that. I disagree. I think what we're going to see, it's going to be quite different. I think inflation can re-emerge. There's a big chance of that. There's also a big chance the rates are going to be higher for longer. And I also think that U.S. stocks are going to struggle again on the back of all that. And I'll share a little more about this. Back a while ago, just about a year ago, a CPI was at 1.4%. You're looking at inflation expectations, so it's a 5-year break even. How you calculate that in the markets is basically what do you expect to be inflation in 5 years from now. Back in 2021, a year ago, CPI was actually at 1.4%. Today it's at 6.5%, and at the same time, as you can see, inflation expectations at the same level. I think this is one of the most mispriced opportunities out there right now. Back in December 25 of 2020, as you can see, I wrote a thread about the Spanish flu. I thought there was a lot of relationships between the coming out period of this pandemic with what happened during the Spanish flu, which was an issue with supply problems that caused inflation to move a lot higher. And it was a very difficult time to be writing this essay, just because I don't think there were a lot of real signs that we had secular shifts in terms of inflation. And today I think it's much easier to see that. Wages and salaries growth have been on a growth for about 2 years now. That is, in my view, just at the beginning. So in other words, corporations are probably going to spend most of their profits with operational costs in general. Number two, commodity shortage. That one was very clear. CAPEX trends have been the way they are for about 2 to 3 years. So that's one that usually tends to be very cyclical. Number three, the reckless amount of fiscal spending, which coming out of the pandemic recession, that was very clear. Today, not a lot of people talking about that because of this kind of delta, the move of fiscal spending actually has been decreasing relative to 2021. But even that, when you look at relative, inflation adjusted all the way back to the 70s, the amount of fiscal spending we're seeing today is larger than any other inflationary period that we've seen outside of war periods. The deglobalization is something that was somewhat emerging, but not as strong as it is today after the war initiated between Russia and Ukraine, but also with the US and China relationship also turning south. So recently we've had import prices coming out, and import prices, if you look at this chart, it was the highest upward surprise that we've seen in history. Or the last one was right at the peak of the tech bubble. It's not to say that we're at the peak of the tech bubble again here, even though I believe things are very frothy. But the point here is the expectations were way ahead of themselves, or not ahead of themselves, the opposite of that, relative to where the number came in. So the question of if will the Fed pivot or not, I don't think they will pivot as soon as a lot of people think, and that will have an impact in equity markets. One of the charts I like to look at is the Fed funds rate in red versus the GDP now. It's a Fed's own calculation of where GDP is presently. And you can see that the two lines actually been growing together, surprisingly, which in my view is another reason why the Fed won't be able to pivot as the market is pricing in today. I've never seen a time in my life where, sometimes when you're looking at the macro stage, you have the dollar, you have treasury markets, you have oil. Today, I think a lot of the views, especially if you believe in this potential re-emergence of inflation, is really on the back of oil. So you really need to look at oil very closely. I think it's one of the most important things to be watching now. Strategic petroleum reserves, everybody knows the government was selling a ton of those, as you can see, right during elections or before elections. Now we're not seeing that change anymore. That change, which it kind of coincided with oil firming up more recently, which I think it's positive for oil overall. I also track operating rigs for oil and gas very closely. That's been rolling over the years, or over the last months as well, which I think it's another thing that we should be watching for. Copper prices have been on a tier recently. I mean, it's been up significantly over the last, 30%? Oil is still, I think it's going to have a major catch up from this. And it's another one of a cyclical asset that if we do see a movement on the upside, I think oil has some catch up to do with copper. Another thing that I like to look for is energy stocks relative to oil prices. You can see here as well that usually the riskier parts of the market, when you have a decline, they tend to lead to the downside. We're not seeing that. We're actually seeing energy prices in terms of the stocks hold up very well relative to oil prices, which I think that leads to the conclusion that we're probably going to see oil prices higher going forward. This is just a little meme looking back when investors are all talking about oil when oil prices are at $120 a barrel, and today at $79 a barrel, nobody really wants it. To me, it's somewhat of a contrarian view. And you go back to this idea that if we do have a recession, which I'm on that camp, but it's just, I don't think it's going to play out like '08 at all, where you had this demand collapse that caused oil prices to fall along the way. I actually think this is going to play out very similar to the 70s, when oil prices are rising as the economy was collapsing. And you can see this by looking at the commodity producers CAPEX cycle, which is a chart that I've been using for over the last years. This is adjusted for GDP, because $1 million spent on the ground today is not the same as it used to be in '08. So that has to be adjusted. And if you adjust for that, today we're, as you can see, at all-time lows right now on that chart. One thing I like to look at too is technicals, and I just looking at the oil prices on a quarterly candles, as you can see here. We just broke out recently with war, as well as the change in political leadership in the U.S. after the pandemic. That caused oil prices to start moving higher. And then we're now retesting the same, what used to be a resistance, now it's a support line. I think we're going to head much higher here. I also think it's important to look at the commodities that are up double digits in the last 3 months. There's now a list of them that are looking quite attractive and have been showing the same signs. Some of them have to do with the reopening of China. Some others have to do with their own fundamentals. But in my opinion, in a way, this is sort of what we call the greenflation, right? It's the green metals that are leading the way to the upside. And then it leads to the conclusion, okay, so if I'm going to have inflation re-emerging, I don't know if it's going to play out through the waves that I usually talk about, the first and second and third wave that we saw in the 70s. But let's just assume we're entering an inflationary decade. And that means that inflation will be higher in terms of the average for the whole decade than we've seen in other cycles. And if you look back in history, the 1970s and 1910s are great examples of that. I've used this chart in the past, and you can see here the equity market's performance is pretty bad. Now, more importantly, a chart that I worked on it yesterday is the multiple compression that you see in equity markets. And so here I'm looking at the 1910s, the 1940s, and the 1970s, where we looked at the CAPE ratio for the US stock market, and you can see here that the average decline for those decades, it's been about 47%. And it begs the question, is that possibility today? Well, the problem is we're starting from much higher valuations today. If you look at the equity markets right now, the CAPE ratio for the S&P 500 today is about 29. You compare that with other times of those inflationary decades. We started those decades at 17 at the highest, which was the 1970s. Today, it's 70% more expensive than those times. So the contraction could be of multiples could be even more severe. I don't know any other time in history that we don't have any real growth, right? No real growth in the economy today. At the same time, we're seeing multiples so excessive. I mean, the market cap to GDP ratio today is retesting the peak of the tech bubble levels. And so to me, this goes back to the whole idea of the growth transition into value stocks, which is something we've been very focused at Crescat, but also other factors, which is the unwinding of a lot of speculative bubbles that we have currently in our system. One of the things that we tend to see during speculative environments is the extrapolation of, especially I would say, earnings estimates, as you can see here. Still, we're seeing S&P 500 earnings estimates to grow about 30%. Do I believe in that? I don't think so at all. I actually think there is a very, I can make a very good case here with the consumer being completely squeezed in many fronts that we might actually see estimates actually, or actual earnings contracting. We haven't seen much of the real bad developments happen in the economy. If you look at bankruptcy filings, there's still a multi-year lows, which I think that's going to catch up very soon here. And one of the things I talk a lot about is the waves of inflation, but there's also the waves of unemployment rates that follow the inflation side. So as you see inflation infiltrating the system, over time, you see a contraction of growth in real terms that then causes unemployment rates to go a lot higher, which I think will likely happen too. So how are we managing money today and positioning in this backdrop? Well, we're short mega cap stocks, and we've been short mega cap stocks for a while now, but I do think there's a lot more to go on the downside. And the first company is just looking at the ratio of market cap of mega cap stocks relative to the S&P equal weighted. So you can see that we broke down from a resistance line recently. But you can see here, Apple is a great example. It's our largest individual short position in our portfolio. This is just one example of how you can look at Apple. EV to sales ratio, you can see here we're twice what we were back during the tech bubble peak. And about exactly where we were back in the peak of the housing bubble as well. So to me, if I think about Apple as one of the companies that really benefited from a globalized environment, it's just hard to believe we'll continue to see that moving forward. Debt valuation and inflation is a chart I've been using for the last years. It's called the trifecta of macro imbalances. This is the reason why I think inflation will continue to be higher over the long term. This is the main reason, is because we have very high levels of debt, we have very high levels of valuations, and we also have an inflation problem, which constrains the Federal Reserve and other policymakers to do a lot to not avoid or to prevent inflation from really growing in the system. So if you have that view, then one of the questions I get a lot is, when is gold going to turn around and so forth? Well, this to me is the most important indicator when it comes to not only thinking about the economy, but also thinking about precious metals in general. And that's the percentage of yield curve inversions. A lot of people like to look at independent spreads. Back in 2018, I created this indicator looking at all possible spreads in the yield curve. And essentially is every time we go above the 70% handle, as you can see all the way to the 70s, every single time we've seen a recession or a downturn in the economy. And the question that comes after looking at this is, what are the assets that perform best during those periods? And the answer is, there are times when the economy actually crashes and the equity markets don't fall. There are times when gold falls along with equity markets actually declining as well. But it's the gold to S&P 500 ratio that tends to be the best form of allocation during those periods. Knowing that equity markets have been in such tremendous pressure over the last years, that leads to the conclusion that we're probably going to see very strong gold prices going forward. We started to see that actually. If you look at gold prices in Japanese yen terms, it's already at new highs. In euro terms, it's not yet at new highs, but it's very close to it. In US terms, it's getting even closer. I think the Japanese yen terms is actually leading the way, and we're going to see the same with gold. If you think about that, then you extrapolate to silver. Well, silver, I've been showing this chart for a while now, but retesting the bottom of where precious metals bottom back in the early 2000s, just looking at silver to money supply ratio, which I think it's one of the most important charts, and why we've been so focused on silver in our funds as well. It surprises me that you have this backdrop for yield curve inversions, and then you look at the metals and mining PE ratio, and it's a multi-year low. The only other time we've seen such a cheap multiples was actually in the bottom of 08. So to me, it's a no-brainer. I think it's time to be allocating capital into the space. When I looked at the basket of commodities that we own, I think clearly that this is one of the things that I think most of our focus should be in terms of deployment of capital. This is probably one of the most important reasons to own gold on the long term. If you want to take one chart of this whole presentation, if you were long gold, I think it's this is the one. Back in the 70s, if you look at central banks, how they used to own central bank assets to give credibility to their fiat currencies, they used to own gold. Gold accounted for about 74% of their balance sheet assets, and today it's below 20%. So you can see that in the second panel of this chart, we're seeing a 5-year rolling change of purchases of gold by central banks, and that increase will likely also increase the percentage of gold holdings as a percentage of foreign reserves, and that will be one of the long-term reasons to own this on the demand side. There are a lot of individual independent ways to look at the gold space, but there are really two gold markets that we've seen since the 70s, the 1970s and also the early 2000s. And they have their own reasons for why they worked out so well. One of them is production related. Production was actually falling drastically during those times. In the 70s was falling about 19%, and gold production down about 11%. Today, with most of the majors being forced to focus more on critical metals, we're starting to see the same decline right now, which I think that just like oil became uninvestable for the last couple years or so, and became such an incredible time to be an investor in the energy space, I think perversely this is going to be very good for the gold space as well. So if you look at most of the major companies, VRIC, multi-year decline in gold production, Anglo Gold, Gold Fields, Kinross. Newmont's production today is the same as it was 16 years ago, by the way. Here is just a CAPEX relative to cash flows, one of the reasons why production has been low, and one of the reasons why we're seeing so many issues in the gold space as well. It's been the very much of a lack of spending in their own projects in general. So we're not seeing a lot of developments there as well. I've been a firm believer that we're going to see an M&A cycle in the space, and why we've been early investing in this part of the industry. Most exploration stocks, if you look at the white line, it's just looking at cash flows that have been accumulating over time, and the other green and red part is just looking at the amount of acquisitions. So less times we've seen an acceleration of cash flows that actually coincided with the time of an M&A, which makes me believe we're going to see something similar. These are cash levels for gold miners, as you can see, are also quite high relative to history, which makes me believe, again, that we're probably going to see something along those lines. But we haven't seen yet the turnover, the real volume coming into the smaller names. I think we're going to see that as well. I don't see a reason why institutional capital is not going to see the many inefficiencies that we find today, especially in development and exploration part of the industry. I think it's a matter of time until we see those big capital pools coming into the space as well. I remember coming up with the chart of CAPEX back in, 2018, 2019, looking at how CAPEX for most of commodity producers have been very low. And, when I think about what's the next chart I should be worried about, this is, to me, one of the most important ones, is the fact that manufacturing relative to GDP in the US is at a multi-decade low as well. You can see that in Germany, in France, in Italy, in Canada, most places in the economy, and that's on the back of China becoming the manufacturing plant of the global economy. What does that mean if we see this ratio beginning to increase over time? And one of the things I think about in terms of how to capitalize, it is the commodities to equity ratio, number one. So you can see the multi-year decline in terms of the commodities to equity ratio during all the other times. We were at a 50-year low or so, just starting to run up here. And the question is, what else can I allocate capital towards outside of gold, mining, and some other things? To me, it's Brazilian assets. I think Brazilian assets are one of the cheapest things that we've seen right now. It's just looking at Brazilian relative to U.S. equities. You can see the ratio that looks a lot like we're at the early 2000s, at the beginning of a major bull market for Brazil. I know that there's political risk, and political risk is definitely priced in most of the stocks that are trading at ridiculous low multiples. Brazilian stocks, as you can see, actually performed very well in 2022 relative to most other things. Its peers in terms of emerging markets, but also the rest of the world, developed economies, U.S., and not only U.S. terms, but in U.S. dollar terms, but also in Brazilian real terms as well. Here is the reason why it works, is because it follows commodity producers so closely. So you're seeing global commodity producers in a blue line on the first panel versus the Ibovespa, Brazilian Equal Weighted Index. And you can see that the two follow each other very closely. More recently, we have a gap there. And down below, we're just looking at that ratio spread. And you can see that right now, again, just like the prior chart, we're retesting the lows of the early 2000s. The banks, we own most of the Brazilian banks in our fund, and one of the reasons is as well just doing fundamental analysis in most of those guys. As you can see, we're at early stages of a bottom here of that part of the industry. So just to finish up my views real quick. We own a basket of commodities with a very large focus in mining. We've just closed a very large acquisition where we're going to own one of the largest silver mines, about 20% stake in one of the largest silver mines in the world. That's a huge focus of ours as well. Long Brazilian assets is another part of where we're deploying capital. We're short a lot of historically overvalued financial assets. Apple is our largest short position as well. We're starting to get long biotechs, and we're still short the Chinese yuan and the Hong Kong dollar. Thank you very much.